Hello dear students. In last class we discussed about macroeconomic identities. So in that already we discussed GDP, GNP, NNP, NDP, personal income, personal disposable income. Okay, these are all what purpose to calculate of national income, to identify how much the country is developing or not, to check that one only. And also, while discussing national income, we are calculating in a particular year. That means during a year or a particular period of time. So while calculating in a particular period of time, suppose if the prices are change, but we are assumed like that prices cannot change. Prices cannot change. But if the prices are changed for goods and services, on that time how we can calculate the national income in a year? Because in a complete year we cannot say the prices are cannot be changed, because prices always changing. Okay, price is a variable, depends upon the demand and supply situation. Prices will be increase or decrease. So while calculating this, definitely if we calculate whole year, the prices will be change. On that base, if we calculate the national income, that time we can get double counting, because in the starting of financial year the price will be increased, in the end of the financial year the price will be decreased. That time what we have to calculate? So in this situation, to calculate national income, there are so many measures. So what are the measures? That is, one is real GDP, another one is nominal GDP. What purpose? If prices change, if the prices change in during a year or during the period of time, that time it's very difficult to calculate the GDP. For this sake, we have to measure GDP of a country in two consecutive years. So what are the 2 years? That is, first we can say like that real GDP, another one is nominal GDP. We have to take 2 years important. So first we have to discuss real GDP. Real GDP means real GDP is calculated in such a way that goods and services are evaluated at some constant set of prices. We have to give importance to constant. Constant means no changes. Okay, here under the real GDP concept, we have to calculate that which one, in order to compare the GDP, we have to calculate GDP through the real GDP only. Real GDP is calculated in such that goods and services evaluate some constant set of prices. Here these prices remain fixed, no changes. Prices are fixed. If the real GDP changes, we can be sure that it is the volume of production which will be undergoing the changes. Okay, suppose while calculating the national income, if the prices are changed, that time we can calculate through nominal GDP. If the prices are fixed, that time we should calculate only through the help of real GDP. Okay, don't forget GDP at the current prevailing prices. Current prevailing prices, that is called as nominal GDP. For example, just 2005 and 2006, just imagination, 2005 and 2006, that is we can call like a single financial year. From 2005 to 2006, that is we can call like single financial year. So in between here 2005 is the real GDP, 2006 is the nominal GDP. Okay, and to understand this one, there is an example. Before that, once again I repeat, real GDP means it is calculated in such a way that goods and services are evaluated at some constant prices. This is nominal GDP is the current prices. Okay, the real GDP cannot evaluated at current market prices, the present. Okay, it cannot be calculated at current like present market prices, but it can be calculated only some constant set of prices. But nominal GDP, it can be calculated at current market price, current prevailing price, evaluate the current market price, the present situation. So nominal GDP can be calculated the price of goods and services, the current market situation or current market prices. It is constant. Constant means no changes. Current means definitely it will be changes. To understand this one, just observe this. Suppose a country only produces bread in the year of 2000 it had produced 100 units of bread. Price was rupees 10 per bread. Imagination, price was rupees 10 per bread. Okay, GDP at current price was rupees 1000. Are you calculating? See, in the year of 2000, a country produces bread, that is 2000. In the year of 2000, it had produced 100 units of bread. 100 units of bread, then price was rupees 10. The totally how much? That is 1000. Okay, that means GDP at current price was 1000. Are you clear? Okay, in 2000, the same country produced 110 units of bread. 110 units of bread at price rupees 15. At price rupees 15. So what is the meaning of that? Here in the year of 2000, in the year of 2000, a country produced 100 units of bread. The price was rupees 10. Price was rupees 10. And that time the GDP at current prices, GDP at current prices, how much? Rupees 1000. Rupees 1000. Okay, at the same time, same country in the at the not at the same time, in the year of 2001, the same country produced 110 units of bread. 110 units of bread. So on that time the price was rupees 15. The price was rupees 15 per bread. That time the nominal GDP in 2001 was rupees 1650. 1650. How we got this? That is 110 into rupees 50. Here real GDP in 2000 calculate the price of the year 2000. 2000 will be called the base year. 2000 will be called the base year. Okay, then 2001 is called the current year. Are you understanding? GNP, like real GDP will be calculated in 2001. Okay, so real GDP in calculated 2001, that time how much happened? So that is 1650. But according to year of 2000, the current price, like GDP at current price was 1000. But the same country produced 110 units of bread in 2001, that is rupees 15 per bread. This time the income, like GDP, was 1650. So that is what we are calculating in 2001, that is nominal GDP. What already we calculated in 2000, that was real GDP. Real GDP. Okay, so here 2000 will be called the base year and 2001 will be called as current year or nominal GDP. 2000 will be called the base year or real GDP and 2001 will be called as current year or nominal GDP. Okay, that was simple. It will ask for 2 marks, nominal and real GDP. When calculating the national income, we are using during a period of time, in a particular period of time, while we calculating, we are assumed like that price will not change. Okay, prices do not change. But if depends upon the situation, if the prices will be changed, and that time how we can calculate the national income, that is help of through two important methods. One is nominal GDP, another one is real GDP. So real GDP is nothing but calculated some constant prices. Real GDP is calculated some constant means no changes, constant prices. And nominal GDP can be calculated at current prevailing prices or current market prices. So okay, previous year what we are present in 2019, it was called as which one? Real GDP. 2020 is called as nominal GDP, because 2020 is a current market price. 2019 was real GDP. Real GDP, it was calculated which one? Constant prices. Okay, anyhow, year 2000, in the year of 2000 we can call like base year, and 2001 is called as current year. right? In example, in 2019 it was called as which one, base year, and 2020 is called as current year, right? So this is a small information about real and nominal GDP, real and nominal GDP. Okay, when the real and nominal GDP calculate, that time we can get which one, GDP deflator. GDP deflator. Why? In order to compare the GDP, like compare the GDP figures, we need a particular concept. What is that? That is GDP deflator. So what is the meaning of GDP deflator? The ratio of nominal GDP to real GDP. The ratio of nominal to real GDP, because it is calculated. See how the prices have moved from the base year to current year, how the GDP or how the prices have moved from the base year to current year, base year to current year. So in the calculation real and nominal GDP of the current year, we have to calculate both, even now base year and also current year. While calculating that, this the production is fixed only. So in this situation, to calculate of present year GDP, we need GDP deflator. What purpose? To calculate the GDP, because we have to use previous year and also present year. That means base year and also current year. To calculate the prices of goods and services of base year and current year, we need GDP deflator. GDP deflator is nothing but the ratio of nominal to real GDP. Nominal to real GDP. To calculate this, there is a formula. See, GDP deflator is a GDP divided by GDP. So this is real, this is nominal. Okay. So in this, through this one only we can calculate national income. That also we should need into 100 percentage. We should calculate in the form of percentage. Okay. So there is another way to calculate of national income. Which one? That is consumer price index. There is another way to measure change in prices, including like real GDP and nominal GDP. Both we can calculate through the help of GDP deflator. Okay, so there is another way to measure the change of prices in economy. So that is called as CPI, Consumer Price Index, because this is the index of prices of a given commodities. Okay, actually CPI is generally expressed in percentage. This is also expressed in terms of percentage. Same as like as we have to take 2 years. One is base year, another one is current year. On that basis only we can calculate the national income with the help of consumer price index, CPI. Already I think you discussed in first PUC only. CPI, then wholesale price index, WPI, right? So this is the other methods to calculate of national income. If the prices are changed, that time only we can use to calculate the national income with the help of real GDP and nominal GDP and consumer price index and also wholesale price index. Okay, so don't forget, real GDP can be calculated at constant prices. Nominal GDP can be calculated at current prices. Okay, so to calculate the present year GDP, we should calculate those both percentage, then base year and current year. So that is we can calculate with the help of GDP deflator. GDP deflator means the ratio of nominal to real GDP. The ratio means percentage. The ratio of nominal to real GDP is the index of prices, is known as GDP deflator. To calculate this, there is a formula: GDP deflator equals to capital GDP and divided by small GDP, okay, into 100. Through the help of this only we can calculate. And another method or measure to calculate the national income, if the prices are changed, that time we need consumer price index. See, there is another way to measure change of prices in an economy, which is known as the consumer price index, CPI. This is also can be helpful to the calculated national income if the prices are changed. Okay, so this is also expressed in percentage terms. Another one is the WPI, wholesale price index. Wholesale price index. Okay, so anyhow, up to this methods to calculate of national income, and next topic and last topic, which one? GDP and welfare. GDP and welfare. So according to the present study, we understood clearly what is that GDP is a perfect barometer to calculate of national income or welfare of the people. Understand, GDP is nothing but it's a national income only. So what we are calculating, what we are understood, what we are studied, the methods and measures is providing perfect information about welfare of the people. Is it true? So, according to few economists, what we are observing, what we are calculating, the GDP or national income, so that is not a perfect barometer to measure the welfare of the people. According to few economists, they are telling that according to them, GDP is not a perfect instrument or a perfect barometer to calculate which one welfare of the country or welfare of the people. So how? If the GDP increase, the welfare cannot be increased. If the GDP decrease, welfare cannot be decreased. So to discuss that one only, we have to understand these 3 points: distribution of GDP, how uniform is it, and non-monetary exchanges, and also externalities. Okay, we have to discuss these points to understand whether GDP is a perfect barometer or perfect instrument to check welfare of the country or welfare of the people. So that is we will discuss in next class. Okay, thank you.